It really wasn't that long ago that the energy market felt, well, almost boring. Yeah, predictable. Price changes were these tiny little things measured in pennies, and the biggest news story you'd get was some regulator's quarterly update. But in the world of global energy, that calm can turn to chaos in an absolute instant, and that's exactly what we just saw happen.
Just look at this. On the left, you've got a headline from late 2025, a 28 pence increase. I mean, you'd barely even notice that on your bill. But then on the right, just a few months later, a forecast for a price explosion. We're not talking about a tiny adjustment anymore. We're talking about a 40 to 50% surge. That's not a ripple, that's a tidal wave.
So the big question is, how on earth do you get from a 28 pence change to a 50% price shock in just a few months? What happened? Well, that's what we're going to break down right now. What was the spark that lit the fuse on the entire global energy market?
The answer, unfortunately, starts right here. A regional conflict that did not stay regional for long. It erupted with just incredible speed and force. And its shockwaves, well, they immediately slammed into the world's most critical energy supply lines.
What's really staggering here is just how fast this all happened. This wasn't some slow buildup. On February 28, the military strikes begin. Within hours, not days, hours, Iran hits back and, crucially, blockades the Strait of Hormuz. By March 2nd, the fight is already shifting from military targets to economic ones, with a huge drone strike on Saudi Arabia's key oil facility. I mean, think about that. In just 72 hours, the entire game had changed.
And that blockade brings us to the geographical heart of this whole crisis, the Strait of Hormuz. It might not look like much on a map, but it's one of the most strategically important pieces of water on the entire planet. And when it gets shut down, the global economy feels the pain immediately.
Okay, so to really get why this is such a big deal, we gotta quickly talk about something called LNG, or liquefied natural gas. All it is really is natural gas that's been super chilled until it becomes a liquid. Why do that? Because it shrinks down, making it possible to load massive amounts of energy onto these giant shits and send it all over the world.
And this number, this is the core of the problem. A full 20%, 1/5 of the entire planet's supply of LNG has to sail right through that one narrow strait. It's not an exaggeration to call it the energy jugular vein of the global economy. So, when that blockade went up, that vital flow of energy was just cut off. The tankers couldn't get through. The entire supply chain was snapped right at its most vulnerable point. 1/5 of the world's supply suddenly trapped. But it gets so much worse. The conflict didn't just block the highway, it hit the factory. Qatar, the world's single biggest exporter of LNG, got hit by drones and had to stop production. We're talking 82 million tons of annual production just taken offline. Poof, gone. The sheer scale of that supply shock is just mind-boggling.
So with 1/5 of the world's supply suddenly at risk or gone completely, the markets didn't just get nervous, they went into a full-blown panic. What happened next was this desperate, high-stakes bidding war, with countries scrambling for every last drop of LNG they could find anywhere on the planet. And you can see the result of that panic right here, clear as day. This is the benchmark gas price in Europe. It basically doubled. It went from a totally stable 32 euros all the way up to over 60. This chart is what a global panic looks like in financial terms.
So you might be wondering, why was Europe in such a tough spot? Well, it was really a perfect storm. First, they'd already moved away from Russian pipeline gas, which made them way more dependent on LNG that comes in on ships. Second, their timing was terrible. Their gas storage tanks were only about 30% full, way lower than the year before. And at the same time, Asian countries, who were also cut off from Qatar, were now desperately trying to buy the exact same shiploads of gas. To top it all off, there wasn't a bunch of extra supply just sitting around. US terminals were already maxed out.
This quote from some analysts at Bernstein it sums up the whole situation perfectly. It became a total zero-sum game. If you're in Europe and you need more gas, you have to pay so much money that you convince a tanker captain to literally turn his ship around and not go to Asia. There was no cavalry coming over the hill with more supply. This was it.
Okay, so the immediate damage is pretty clear, but the really scary question is, where do we go from here? Well, analysts at UniCredit have laid out two very different paths for what could happen next.
So let's call it a tale of two futures. On the left is the baseline, a sort of best-case scenario. Here, the conflict is short, just a few weeks. Prices will eventually come back down, inflation gets a little bump, and the economy takes a bit of a hit. Painful, but probably manageable. But on the right, you have the adverse scenario. This is the scary one. The conflict drags on, gas prices could rocket up to 100 euros, inflation jumps way up, and Europe faces a very real risk of economic stagnation or even a full-blown recession.
So that leaves all of us staring at this one giant critical question. Is what we're seeing right now just a temporary shock that will fade away? Or is this the beginning of a much deeper, more painful, and lasting crisis?
In the end, the price you pay to heat your home, the health of our economy, the stability of the entire global market, it all comes down to events unfolding thousands of miles away. It's just a stark, powerful reminder of how deeply interconnected and maybe how fragile our world really is.